Hey guys, so have you ever wondered how companies like Canva, Uber, or even Airbnb made their first $1 million? Well, the answer is venture capital, and that's what we'll be talking about today. Now, what is a VC? VC stands for venture capital, and they're essentially firms that invest a large amount of money into high growth early startups. Now, these startups are normally unproven, they don't really have a track record, and it can be risky. However, at the end, when they exit, the returns can be massive for VCs. So venture capital is really broad and there's so much to talk about, but for this episode, we'll just break it down into what exactly VC is and how they make money and how they can help companies. Now, in exchange for the funds VCs provide to startups, they also get ownership of the company. So for example, say Uber started off and they invested $10 million into Uber, they may request 30% equity. So they own 30% of the company now. Now, VCs don't just offer funds, but they offer, much more value than that. That includes, talent to acquire for startups, regarding, execs or employees, strategic decision making, when making financial decisions, or, whether that be acquiring or selling parts of the business, hiring new employees, R&D, and, any partnerships or all that. So, they're not just investors. Think of them more as business partners. So how VCs typically invest is through a number of rounds. Now, the first round is called the seed round, which is more the early stage round. Company has just started off more in the early product development stage, and they require $3 million. Now, every round after this is called Series A, Series B, C, D, and beyond. So depending on the structure, depending on what the business needs, each round the VC provides more funding. And for every round providing funding, they obtain more equity of the company. Now, you may be asking, how on earth do VC firms even get this much funds or obtain this much capital to invest in startups? Well, the main contributors are LPs, GPs, carried interest, and management fees. Now, I won't get into too much detail on what they are, but that can be in another video. For now, I'll just explain LPs. Limited partners are the main investors, so they invest most of the money into the VC firm to start with. GPs are general partners, so they run the fund, they run the VC fund firm, etc., and they also put in their own money. Management fees are ongoing annual fees to run the fund, and carried interest is around 20% of the profit they make. It goes back to the VC firm. The rest goes to the LP or GP, etc. So there's a range of ways that VCs make money and are able to do what they do in terms of help startups. Now, how VC typically makes money is when they exit. So that can be through an IPO or an acquisition. So an IPO is initial public offering, and that's when the business goes public and lists their shares on the public stock exchange. So when the VC initially provided funds to the business, they did so at a much lower valuation. And so the shares that they bought were done at a much lower valuation, meaning the shares were cheaper. Now, when the business goes public, those shares are worth much more and is now valued much more highly. So that difference when they sell their shares is a massive profit for them. Now, for the other option, acquisition or merging acquisition, is when another company buys the firm. Now, that money that they get, say they get bought for $300 million, depending on how much the VC owns of the company, say 10%, they would take 10% of the profit. Now, there's other structure to it, depending on what structure it is. There may be other, fees involved or discounts, bonuses, whatever. But typically, that's how it's done. Whatever the VC owns of the company, they take that much of the profit. Okay, guys, just to summarize, VC, venture capital, are firms that provide a large amount of money to startups, typically ones that are just growing and want to expand, just in the development stage, and they want to get their product out there, and they need the funds to do so. Now, how they get money is through investors, GPs, LPs, etc., and they get paid through exits as well. So that can be through an IPO or an acquisition. Now, when the VC also provides funds, they do get ownership of the company, and that's how it's done. So, for example, $10 million into this firm, they make 30% of the company. So now they own 30% equity. Now, that will be it for today's video for venture capital. I will make another video for VC just because of how broad the topic is and how many terms and keywords aligned in terms of understanding